Good evening, everybody. It's Andy O'Fee, the Yankee closer, and here we are finally with our 2020 new outlook to find out what's going to happen in the markets as we approach the new year. I apologize, this is a couple of weeks late, but had a little baby action going on in the O'Fee family. Maxwell Andrew O'Fee was born last week, so kind of got things tied up a little bit. But here we are. We're going to move forward. We've got a lot of great information for you to share with your clients. And I hope you guys can come back to me and ask me any questions or thoughts that you may have in regards to what could impact the market as we go forward. Let's dive into this great PowerPoint presentation, and I look forward to sharing it with you. So here we go, forecast 2020, new year, new decade. So let's go ahead and find out what we need to watch out for as we go into the new year. So market dynamics are the most important. The first thing we're going to talk about is the Fed and their quantitative easing, which has been done very secretively, considering they were talking about offloading a lot of the balance sheet. Basically, they've been buying about $100 billion in short-term treasury debt for a period of time. The trade deal, let's talk about that. Phase one has been complete. It wasn't the greatest part of the deal that the president wanted. However, it did go through, and as a result, we saw the stock market take off. The presidential election is also weighing in on the markets too, as we move into it towards the end of this year with Trump the front runner, but he does have some serious competition on the Democratic side. Who will be the winner and what impact will it have on the markets as we go into the following year? Stocks, we all know they have hit all-time highs. When are they going to break away from these highs? Will they continue to move higher? Who knows? Honestly, it's right now we can all ride the wave. Net worth is going up. A lot of people have money. People are working. There's really no signs right now that shows that this is going to change. But both greed and the valuations on stocks are extremely high. The housing inventory and affordability, we all know that inventory is at all-time lows. Affordability continues to be very reasonable considering people are working, and average hourly earnings and weekly earnings continue to rise. So even though prices continue to go up, people can still afford to buy homes again, all going back to everybody working. Demand will continue to remain strong as we go into 2020, and we're going to talk about children, and yes, children and the impact that they can have on the housing market as we go forward. Recession probability indicators. Towards the middle half of the third quarter of last year, we did see the curve invert slightly for a short period of time, which is a good indicator of the recession happening. Unfortunately, it didn't happen for a long period of time for the market to even react to it. But at that point, we saw the Fed start to manipulate the front end of the curve and change the inversion of the yield curve so that it wasn't there anymore. We're going to talk about the biggest indicator we always talk about, and that's the labor market. If that starts to slow down, that is a telltale sign of what could happen with the economy. Interest rates, we're going to talk about them right now. We've been enjoying a great run here for the past 10 years. I got to tell you right now, I think we're going to have the same scenario as we go into 2020, and we'll enjoy these low rates as we move forward. And my role as an advisor for both you as well as your clients as we start to take a look at some of the fintech companies now that are coming in and actually pushing away some of the referrals from you that are here locally and pulling referrals away from me too, as more and more people are being driven to the internet to do their mortgage. So let's go ahead and talk about the Fed. Well, they cut 3 times in 2019 at the end of the year, and as a result, we saw the stock market take off, and that was a huge move that really put a lot of pressure on mortgage rates. Now, rates have basically balanced themselves out, even with stocks continuing to rally, and I firmly believe that has a lot to do with the Fed purchasing of those short-term debt and keeping rates as low as they are. So what are the Fed funds rate going to do for 2020? Well, I think they're going to keep it where it is right now. I don't see anything that would cause them to make any type of move. Inflation is extremely low. The economy continues to churn along. There's really no need for them to come in. The moves that they did at the end of last year really did a wonderful job for the economy. So this is what we talked about earlier, QE. Let's talk about the purchases of treasury bills. This is the Fed balance sheet as we go throughout the years. And you can see as we got in towards the end of 2019, we hit an all-time low. And then all of a sudden, they started coming in and purchasing short-term treasury debt at $100 billion per month. That's a B, billion, and that's basically driving up their balance sheet one more time. So as we get into it, what is the Fed QE going to do if it stops? What's going to happen to the marketplace? Will it create a major move? Well, if they do continue to purchase this short-term debt, we would anticipate seeing the stock market do very well, and we'd also continue to see the rate market do extremely well. But if they do stop it, what are they going to do with that balance sheet? Will they start unloading it again and putting more pressure on short-term rates as well as our mortgage rates? Well, let's see if that happens. As we go into the debt levels, we also know that the U.S. Treasury has to issue Treasury debt in order to sustain the debt levels that we have, and they are extremely high right now. Foreign nations who, for a long period of time, were big buyers of our debt, U.S. Treasury debt, have become net sellers for the most part. Will they continue to sell and purchase their own product, or will they continue to put money into the stock market? Now, let's take a look at the demographic of the Fed. So, the voting members rotate, and out from 2019, we have two Hawks and one Dove, Bullard, George, Evans, and Rosengren. And look, the Doves are really the guys that want to sit back and they want to have a very, very light approach to monetary policy. Where the Hawks that are coming in, when they come in, they want to be in, they want to be very aggressive with monetary policy. And those are the guys that are very inflationary sensitive. So we're losing two Hawks in the market and one Dove, and Evans is neutral. Coming in, we basically are going to be looking at a one Hawk, Harker, who was former president of the University of Delaware, FYI, and Kashkari, who basically is a double dove. This guy is off the charts. He just wants to see monetary policy go very, very calmly, and he wants to push to continue to see rates as low as they are. So basically, we gain one more dove, in my opinion, into the position of voting members of the Fed. Good news for us. Okay, the trade deal, as we talked about, phase one is complete. Although the amount was a smaller amount than what the president had anticipated, it still was a significant market mover in 2019. As you can see, it made a huge move so far in the beginning of this year once they announced that. So the reduction was hoping for 25 billion reduction as far as tariffs go. They got 9 billion, which again was much less substantive than they had hoped for, but again, still something very good. And phase two now will also weigh in and depend really on how the election plays out, and just to see how much China is willing to play around with the president in order to get this phase two deal done if he is the next guy. And of course, intellectual property remains a challenging point. We've all talked about that and how they have been stealing, quote unquote, information from us in order to help grow their business. We can get into that at a completely different conversation, but that is a challenging point right now between the Chinese and the American economies. So the election for this year, pardon me, it's the president against the top three runners, Joe Biden, Sanders, and Warren, and it'll really be very, very interesting to see what happens with Trump being the favorite and what would happen if he continues to look like the front runner to win. Will the equity markets will have a tendency to continue to move higher when it is more evident that he will, in doubt, be the next president? It's clear he is the front runner. However, if there is a challenge from Biden or any other of the Democrats that are coming out, then what is the significant market turmoil that we could see? Well, again, thinking about things strictly from an interest rate perspective, we have to remember that when the stock market goes down, we like to see mortgage rates follow, and they would. So again, some interesting things to think about with the Democrats coming to play and doing their best to try to take Trump out. It'll be curious to see how the market would react to that. So again, as his chances for re-election improve, so will his resolve on negotiating a tougher trade deal with the Chinese. So that is something to remember also. Now, the stock market, price earning ratios are extremely high, and QE, like we had mentioned earlier, are giving stocks a lift with that purchasing of the short-term treasury debt, which again gave the stock market a huge push. So there will be, well, maybe, will there be an eventual pullback in stocks to help bonds? That's very unclear right now, even though we are at all-time highs. So this is the fear and greed index that comes out with CNN. At this time last year, the fear index was at a 5. Today, it is at a 92 per the CNN index that they track. Well, buy the dips or sell at the highs. Who knows? Are we going to continue and push forward as far as where we stand with price earning ratios so high right now? Is the economy running too hot? Very, very unclear to think about. But in the meantime, enjoy it while your portfolios continue to gain. Now, the housing market, let's take a look. There is a rise in affordability due to wage gains. We talked about that a little bit earlier in how weekly and our average earnings are continuing to rise, which is great news. People are working and they are being paid. So that will impact how people can purchase a home, especially since prices continue to appreciate. And that is all depends on the relative price. Rents, most importantly, will continue to rise also. And as we talked about at the beginning of the year, and we're going to talk about it again here in a little bit, you need to be aggressive as a real estate agent, in my opinion, to go after the renters in the Shelby County area. There are a lot. There are a lot of people that can afford to buy. They just are very fearful, and they need the education from you, the real estate agent, to get them pushed over the edge to understand the value of home ownership. Again, we're still at historically low levels in inventory, which again could push people away from wanting to buy a house. But again, for the most part, I think people have been very, very patient and they are getting the homes that they want, even though they may not getting it on the first swing. So here's the record low inventories that we sat at. But what's most interesting is that when inventory levels are extremely high, the peak being 3.8 right here back in 1987, that was the first blow up in the housing market. Hey, look what happened in '07 and '08. We all remember those years, peak inventories again. Here we are back now at the first quarter of 2019, towards the end of last year, and now we are at historical lows. So you would not look to see for a housing implosion anytime soon, given the fact that we are at historically low inventory levels. Now, what's interesting is millennials living at home. The oldest millennials this year turned 39, with the average age of the homeowner, home buyer, at 33. So first-time home buyers should continue to increase. So take a look at these two charts pretty quick. The age of your first marriage back in 1960, it was in the early 20s. Now, as we get into the latter half of 2019, you can see more people are waiting to buy homes. The same thing goes with your age of your first birth. So you can notice that people, as they wait, more people now are coming into play to buy a home, which is great news for us. Millennials, as far as I'm concerned, are going to drive this market this year. So let's talk about children too. And this may not sound like rocket science, but it's something that really needs to be brought to the forefront. Those that are living alone right now, 38%. Married with children in an age bracket of 30 to 39, 80%. And if you have two children, at 82%. So what happens? You get married, you have a child. Well, the first thing, life-changing event, people want to get into their own home. Again, go back to that previous chart and note, people now at those millennial age point where they're getting married and having children are now going to start coming out and they're going to be purchasing homes. Millennial is the magic word as far as the housing market goes in 2020, as far as I'm concerned. One more goofy little thing to look at, I think is very cool, was the popularity of Google search terms back in 2008 versus where we are at today. So wedding registry, baby registry. If you'll notice, as we got towards the latter half of 2000, you can see that more and more people were pinging Google for those types of things, a wedding registry or a baby registry. Just a very, very simple way of analyzing how the housing market can be impacted by those who are married and have children. Okay, recession, the big R word. Everyone was talking about it. Everyone was trying to strike fear in the market. Well, recession at the end of 2020 is still a possibility. However, I believe it won't occur until 2021 due to the fact that the Fed is going to continue to buy short-term debt. If they pull the carpet out from under that and see if the economy can maintain itself, then we're going to have to see if that possibility of a recession will come into play. We're still in the longest expansion on record as far as economic growth. When is that going to stop? Well, honestly, in my career, I've not seen it this long either. I think we have another year or two to go. And again, we need to all enjoy this period of time in the real estate market where we are, because again, it is a great business to be in. Manufacturing, though, is starting to struggle already. And we also have a chart that we follow as far as shipments being on a declining basis that we look at. That's also an early sign of what could potentially happen as far as a recession. The yield curve was inverted prior to the financial masking, which was that quantitative easing. But let's go back to the most important asset that we need to take a look at, and that is where we are in the unemployment market. Right now, the rates are historically low. Jobless claims have not moved higher. We need to watch those numbers. They come out every Thursday. Of course, the jobless number comes out, the job creation number comes out every beginning of the month to determine where we are from a job standpoint. Huge thing to remember as we go throughout the year. Unemployment is the telltale sign, the first sign that we're heading into any type of recession. So, what to remember though, when we do hit a recession, rates do decline significantly. Great news for the housing market. So, shake off the word recession if you hear it from anybody. It's good news one way or the other for us in the residential housing market. So, if you take a look at these unemployment and recession numbers, I told you those are the most important things to take a look at. The gray bars are where we did hit a recession, and you'll note that each section, when the unemployment rate did move, we did slip into it. So right now we are all the way at the bottom right now as far as unemployment goes. Again, any spike that you will see, here you go, it started moving up, boom, recession, started moving up, boom, recession. It operates just like clockwork, and we're going to keep our eyes on that as we go forward in 2020. So let's talk about mortgage rates, most important thing that we need that I like to follow on a daily basis. So recession, well, we all know that, hey, it's a possibility. I don't foresee it happening. Reasonably low inflation, also a killer for fixed income securities that will impact where rates are. But with no inflation, there's no reason why rates would end up moving higher. Stocks, we all talk about that. People buy stocks, they come out of the bond market. Less risk involved in the bond market. If that switches and people start to unload stocks and they get into the bond market, well, that will end up pushing our rates down. Global yields are at historical lows also. Now they have come up. You can take a look. The 10-year note in the United States is at 187. Similar government bonds across the world are at similar levels, and even some are at negative. However, they have come up from earlier in 2019. Any type of pressure that we see overseas will inevitably cause pressure on our side also. Let's just hope that we can kind of maintain ourselves and not get pushed up over that 2% level, which I think could be the top for yields this year on the 10-year note. So this year, my role as an advisor in the year ahead and in the decade ahead, as more fintech competition comes into play, it's hurting your business because people have a tendency now to rather just go online, find the property, find the realtor online, and they're also doing that as far as lenders go. So it's imperative now that we're out there and we're making sure that we can make as much face-to-face contact with our clients and help them make the correct financial decision face-to-face. Be your lender for life. Be your real estate agent for life. My advice for wealth creation will be more important than ever. It's not necessarily always about putting a first-time home buyer in a house. It's about talking to somebody who's been in a house for 3 or 4 or 5 years, has had a life-changing event, has had a large amount of debt grow. We need to talk about something called debt consolidation. And that's something that we can do. 76% of mortgages are at 5% or lower in the United States right now. Those are people that can take advantage of the equity in their home and help consolidate some of their debt and restructure it. Easy way of doing that. I sent a message out about that about a month ago. Something to think about as we go into 2020. So this is Andy O'Fee, the Yankee closer. That was 20 minutes. I know my wife is going to say, wow, who's going to end up watching all of it? But I hope that everyone will, because again, there's some great information in there. Please, please, please call me if you have any questions. Share it with your clients and help them make good financial decisions and watch the market as we go along. Happy 2020, and we'll see Max real soon here on Mondays with Max. Bye-bye.